Good morning. Well, by now, everyone's heard the news. Everyone's freaked out. Everyone's ready to destroy the Biden administration
God.
because they've changed loan level pricing adjustments.
Oh my goodness, this is
Oh,
craziness. It's like it came out of nowhere. I didn't know it was going to happen since
what?
January.
Wait. You
Wait,
mean that announcement they had in January?
wait. That's the same announcement?
Yeah.
Oh, okay.
Yeah.
All right. So this isn't new news. Well, I guess it is new news for
Yeah.
people.
It's just nobody bothers to read anything. And good morning. I'm Brendan with Homes in Orlando, and we got Joe with Aptly Home Loans. And we just wanted to bring this to you this morning to try and really clarify some of the information that's out there because, my gosh, I must have seen 30, Instagram reels, YouTube reels. Everyone's freaking out. Everyone's
It,
just reading the Washington Times.
it's
Everyone's throwing up this stupid,
it's all
um,
anybody wanted to talk about this week.
yeah,
Like, I
yeah.
had I'm pretty sure every one of my clients this
How many
weekend were
calls do you
like,
get?
what's going up? Why is my rate getting worse? Should I wait to buy? Is this, and I'm like, no, like, but it, it kind of does stink. It's LLPAs, loan level price adjustments.
Yep.
They are going up, and they are going up across the board, right? And then there's a small contingency that went down on those LLPAs.
Yep.
So, I know that we're going to take a look at that, but that's kind of the hard part is I think the media is running with, oh, well, we saw a little bit of improvement in these areas, which means that people with stronger credit scores are paying for those. No, not really.
No, it's no, it's not how it works really. And I saw it, and I just, Fox News threw up this stupid thing. Oh, people with 620 scores are going to get a 1.75% discount on their rate, and
Ooh, I
people with
wish.
740 are going to get a 1% increase on their rate. It's like, no, that's not how it works. So, I mean, I think to start with, we just got to kind of pull back and actually explain what happened and the time frame in which it happened.
Yeah.
The LLPAs just don't come pulled out of the air.
No.
They don't. They were actually announced in January that they were coming out with the new LLPAs, correct?
Yep. Correct.
Okay. Then in March, we actually got the new adjustment sheets for the LLPAs, correct?
They started trickling out a little bit beforehand from some of our back-end investors. They got them
Mm-hmm.
ahead of when we did. But in March is when we did. But in March is also when we saw that they pushed back some LLPA adjustments that are going to be
Mm-hmm.
happening as well to August. But the
Correct.
ones that were the attention today are in reference to credit score and down payment. That we
Mm-hmm.
knew without a doubt in March, and we knew it was going to go into effect beginning May 1st.
Yep.
Here's the key. It's when it's delivered to Fannie Mae and Freddie Mac, like not when we lock it, not like so interest rates today, interest rates at the start of April, we've already had these adjustments because guess what? If I locked your loan April 1st and you're closing April 30th, right? Well,
Mm-hmm.
probably not the 30th because that's a Sunday, right?
Yep.
April 28th, we're not delivering the loan to Fannie Mae, Freddie Mac until after May 1st. So in April 1st, you already had these LLPAs built into your pricing.
So all this pricing that they're raising a stink about is already in there.
It's already in there.
We're seeing it.
Yep.
And when did you first start seeing this? Like end of February, March, probably because of
Probably right around is because of delivery time. It was probably end of February, start of March, maybe mid-March for some lenders. A lot of conservative approach on how they handled it. So these things went into effect much sooner, which if we look back on some of our data maps, right, we
Mm-hmm.
saw the best improvement in rates end of February, start of March, which means probably we saw some rate improvement that happened right around when these LLPAs started being priced into loans.
Ah, oh, but we're not going to say that.
Probably not. No, it's
Yeah.
okay.
I mean, I know we both get frustrated, and this is just one of those things where just taking a headline and running with it, people got to stop doing that. They just got to stop and really look at the details of it. Because,
Yeah.
like you mentioned, one thing they have done is the DTI, which I think affects more people these days than anything else.
Yeah.
They were supposed to start May 1st too, I believe, but they've been delayed to August 1st.
Yep.
At this time.
Correct.
And what's going to happen? Are we going to July 26th all of a sudden get a news article out? Oh my gosh, more adjustments coming out of the blue, da da da.
Probably. I would expect something like that. Or was this such big news because of some other turmoil going on into the marketplace and they wanted to kind of have our attention in one area than the other? I don't know. I'm not going to get into conspiracy theories.
You mean like the 11 banks that got downgraded by Moody's?
Well, that's a pretty big one.
You know?
Where's that news? Not important.
We have maybe another possible bank run in the next couple of weeks.
I don't know, but we had some changes.
Yeah, but overall, it's just let's look at the actual adjustment sheet. This is the actual adjustment sheet that you're going to be using for delivery of loans.
And they did this as a heat map, right? So a heat map. It's kind of this is the actual adjustments that we have, the actual loan level price adjustments. So it's not, we've been seeing a lot of heat maps that are like, this is how much worse it's gotten or better from the old one or the new one. These are the actual LLPAs that are on these rates, right? So if you have I don't know, what is that? A sub 639 credit score. So your credit score is bad.
Yeah.
And you're putting 75 to 80% down. You're paying 2.750. And there's into loan level price adjustment. So when we say paying, that's being built in the pricing. So the pricing, the cost for that rate is worse. You may not be paying that out of pocket. It might be a higher interest rate or something of that sort. But you can see that the areas that are the worst, right, are the darkest red, and then the best are green, right? So your green is going to be low loan to values, right?
Yeah.
Like, and
then the green is actually where there was like no adjustment or positive adjustment. Red is where it got worse from previous, and yellow it's kind of basically stayed the same. So if you look, like you mentioned, if you look at 640 and you're putting, say, 75% down, you're at 2.75. But if you've got a 760 credit score, your up fee is 0.625.
Correct.
So is the person with the lower score paying more than the person with a higher credit score?
Yeah. And I think when you look across the board on every one of these, you see that the person with the lower credit score does pay more. Now,
and that was the big thing in a lot of these, where people were just like, oh, the person with the low credit score. And the way they made it sound was, oh, these high risk loans.
Yeah.
These really aren't high risk loans. A lot of these.
Well, I think what they're forgetting to talk about, and this is one that I think is so important, is this is just the price rate. This is just the loan level price adjustments for what the rate would be. They still have to get and approve eligible and accept eligible if they've got to get AUS binding, so automated underwriting system, because there's no manual loans on these products, right? They have to get automated underwriting findings for their loan. And guess what? It's a lot harder to get that approval when you have a 640 credit score or a 660 credit score versus a 740.
Correct.
And that's the thing that nobody's really covering is these are just the adjustments to the rate. It doesn't mean that your 640 borrower putting, 90 to 95% down is going to get that loan. It doesn't mean that they're going to get it. This is just piece one, and there's still, 2, 3, 4, and 5 that has to happen before the borrower gets the loan.
And that's probably the one of the best points of it is you still have to get approved for the loan.
Boom.
They're still going to take into account people's debt to income ratio. How long they've been at their job. All that information.
And things that matter now, these things certain things didn't matter 10 years ago that matter now. We pull our credit reports, we have trending data now. So we look at and approve eligible stuff. We're looking at things like, the system's calculating, are you making minimum payments every time or making more than your minimum? Are you leveraged? How much are you leveraged? How much of your credit utilization are? What's the age? Like how many accounts? It's looking at all those details, and people with lower credit scores are typically going to have more risk thresholds that are going to ding them on these systems versus people with stronger credit scores. Whereas someone with a 760 credit score maybe get a positive factor for that system. Someone with a 680 might get a 2 or 3 negative dings for that same
Yep. So we just wanted to bring this to you this morning because it just, there was so much, what would you call it, unrest about it.
Yeah.
And that a lot of times just comes because of lack of true information of what is going on. Oh, I lost Joe there. So we wanted to take a moment and go through this with everybody. Thank you for joining us this morning, and we'll see you on Thursday at our regular time. Take care.
Thanks so much, guys.
Hey, you're back. Say goodbye.